Assalamu alaikum. Inshallah, today we will start our own first digital lesson because of the spread of virus corona worldwide. Now we cannot have face-to-face classes, and we will shift to online or digital classes. So the process will be as the following. I will record a video lessons on a weekly basis, and I will upload these lessons on Moodle. Also, I will upload with these videos some exercises as usual, maybe assignment for that chapter if this is the case for this week. And I will try during these video lessons to solve the exercises, and you will see that on your desktop when you run the videos. So I hope that will be convenient for you. Please just watch the videos that I will upload, and I will be very happy to hear from you about your feedback and whether you find these lessons useful or not. Okay, today inshallah I will start with chapter 8, which is about inventories. So in this chapter, the main focus will be about inventories. Accounting for inventories is all covered in IS2, International Accounting Standard 2. So first of all, we will talk about the scope and objectives of this standard, and then we will define the inventory. We will know about its different types and how it is classified. Then next step, we will talk about costs included in inventory. After that, we will talk about cost flow assumptions such as FIFO and average cost. You took this before in accounting principles, but now we will just talk about it in a more comprehensive way. Also, we will talk about effects of inventory errors, and finally we'll talk about inventory valuation. And the rule for this, as you will see, it will be lower of cost or net realizable value. Okay, what are the objectives of IS2? We said before it prescribes the accounting treatment for inventories. So it gives the guidance about how to determine the cost of inventories, and how then this cost will be recognized later as an expense, and whether we need to have a write down for inventories or not by the year end, according to the lower of cost or net realizable value rule that we will talk about later in this chapter. The scope of IS2. So as we said, the scope will be about accounting for inventories, recognizing inventory and valuation of inventory. However, this standard will exclude certain inventories from its scope, because these other inventories will be recorded, will be accounted for by using other standards. So this IS2 will not cover work in process arising from construction contracts, and also financial instruments. Also this is covered in another standard. Also biological assets that is related to any agriculture activity. This is with regard to the scope of IS2. Now, the first question: what is the definition of inventories? Inventory is any asset held for sale in the ordinary course of a business, or any asset in the process of production for such sale, or any asset in the form of materials or supplies to be consumed in the production process or rendering of services. So we have three items in this definition. These items simply summarizing the different types, or describing the different types of inventories that we can see in a merchandising company or a manufacturing company. For example, if we have a look to a merchandising company, we will see one type of inventory. So this is we will see assets, finished goods that is held for sale in the ordinary course of a business. So this is the first item. The second two elements, we can find them in a manufacturing company. Namely, they are raw materials and work in process. So in a manufacturing company, we will see items or assets used that will be processed to or manufactured to finally get a finished goods that we will sell to our customers. So as you can see, we have in a manufacturing company, we'll have three types of inventory. We have a finished goods, work in process, and raw materials. Now, let's have a look to the cost flow for these inventories. First of all, if we look to a merchandising company, they have one type of inventory. We call it merchandise inventory. This inventory, it will be recognized as an asset and in current assets. Then it will be recognized as an expense whenever it is sold. So when we sell inventory, at that time we can recognize cost of goods sold expense, which appears in the income statement or profit or loss statement. If we have a look to a manufacturing company, now the costs of raw materials and labor and overhead will flow and we will become part of the cost of work in process, which is a type of inventory, and then units that is that we are done with it, that we finished manufacturing or processing, then these costs will go or flow from work in process to finished goods. And then finally finished goods, whenever it is sold, then at that time we can recognize the cost of inventory as a cost of goods sold, which is an expense in the profit and loss statement. Now we will talk also about two systems used for inventory evaluation or valuation. The first one called perpetual system and periodic system. So first of all, let's start with the perpetual system. According to this system, the perpetual system, purchases of merchandise are debited to inventory. So the inventory account and cost of goods sold account, as we will see later, will be inventory account will be updated every time we make a purchase of merchandise. Also, any freight in is the shipping cost that we need to get the purchased inventory. So now for the first one, every time we purchase merchandise, we have to debit inventory. Also, any freight in paid to get inventory must be also debited to inventory, while purchase returns and purchase discounts are credited to inventory. So as you can see, the inventory account will be debited for each purchase and credited for any purchase